In this section, we're going to cover S corporations, which have very similar tax characteristics to partnerships. So some of this stuff, or most of this stuff, should seem fairly similar. Some of the S Corp advantages include exemption from corporate tax. It's a flow-through entity, just like the partnership and the LLC. It's eligible for the qualified business income deduction. You do not have double taxation, so there's no entity level tax. All capital gains, dividends, and tax exempt income retain their character. Deductions, losses, and tax credits pass through and also retain their character. The S Corp earnings are not subject to self employment tax, and they're not subject to personal holding company or accumulated earnings tax. But some disadvantages. The shareholder's marginal tax rate may be higher than 21%. So if you recall, the C Corp tax rate is currently a flat 21%. So the shareholders may have a higher marginal rate than that. Earnings are going to be taxed to shareholders even if they're not distributed. So you may have that wherewithal to pay issue if you are attributed income but you don't have the cash to pay the tax. S Corps are subject to an excess net passive income tax and a built-in gains tax, and we'll talk about that in this chapter. Dividends received are not eligible for the dividends received deduction. Special allocations of items of ordinary income or loss and separately stated items have to be made. Loss limitations for S Corp shareholders are smaller than those for a partner in a partnership, and S Corps can only increase their loss limitation by making loans to the S Corp. S Corp shareholders are subject to at-risk, passive activity, and excess business loss limitations. There are limitations to the type and number of shareholders, and there's less freedom in the choice of the tax year than there are in C Corps or partnerships. To be an S Corp, there are a few shareholder requirements that have to be complied with. First, there can be no more than 100 shareholders. But family members and their estates count as one. So if my husband and I are both shareholders of an S Corp, we count as one, not two. Shareholders must be individuals, estates, certain tax-exempt organizations, or certain kinds of trust. You notice that C Corps are not in there and partnerships are not in there. So a C Corp and a partnership cannot be an S Corp shareholder. Tax-exempt 501A organizations can be shareholders, and each organization counts as one shareholder. And none of the individual shareholders may be non-resident aliens. And the corporation-related requirements. So first, the corporation is a domestic corporation or an unincorporated entity that elects to be treated as a corporation under the check-the-box regulations. The corporation must not be an ineligible corporation. So the corporations that maintain a special federal income tax status or the corporations electing the special Puerto Rico and U.S. possessions tax credit are ineligible corporations. And the corporation must only have one class of stock. So all shares must confer identical rights to distribution and liquidation. And debt is generally not treated as a second class of stock. So the S Corp can have debt in one class of stock. To elect, the shareholders must all consent and timely elect, including those who own stock during any portion of the year preceding the election date. And then to terminate an S Corp election, the shareholders can revoke. So shareholders owning more than half of the corporation stock on the day of revocation must consent to a revocation. So they can do that. Or the S Corp election can involuntarily terminate. And termination occurs upon a terminating event. And that might be exceeding the 100 shareholder limit, having an ineligible shareholder, creating a second class of stock, attaining a prohibited status, selecting improper tax years, failing the passive income test for 3 consecutive years. So a termination would occur when some event happens that is not allowed under the S Corp code sections. If the termination is inadvertent, the corporation can continue with the S election if they have taken necessary steps to correct the error within a reasonable time. And once termination occurs, the corporation must generally wait 5 years before making another S election. The S Corp operations have to follow these guidelines below. First, the tax year is December 31 or a fiscal year if a corporation can establish a business purpose. The choice of accounting method can be independent of that of shareholders. The ordinary income and loss is going to be computed at the S Corp level, just like it was for the partnership for all the flow-through entities. And then the S Corp is going to have separately stated items that have limits that are going to be applied at the individual shareholder level. So those separately stated items include net short-term and long-term capital gains and losses, Section 1231 gains and losses, unrecaptured Section 1250 gains and losses, the Section 179 expense, any charitable contributions, dividends and interest income, taxes paid or accrued to foreign country or U.S. possessions, tax-exempt or partially tax-exempt interest, investment income and expenses. And just like before when we were talking about partnerships, these items are going to preserve their character on the individual 1040 and flow through to the shareholders. And like the C Corp, the S Corp can elect to amortize organizational expenses. There are some special S Corp taxes that come about to prevent the S Corp from being a vehicle to shield certain types of income. The first we're going to talk about is passive income. If the S Corp has excess net passive income, then we have a special tax that's going to apply at the S Corp level. So the excess net passive income tax is going to apply when passive income exceeds 25% of gross receipts, and at the close of the tax year, the S Corp has subchapter C, earnings and profits. So this applies when we had a C Corp that has now elected S Corp status, and we have still earnings and profits from the subchapter C Corp. And remember, passive income is not service income, right? So rents, royalties, dividends, interest, things like that. The tax is going to equal the excess net passive income times the highest corporate tax rate. And for this year, the only corporate tax rate is 21%. We calculate excess net passive income as the net passive income multiplied by a fraction, and the numerator of that fraction is passive income minus 25% of gross receipts divided by passive investment income. And the tax is going to reduce passive income that flows through to the shareholders. In problem 34, we have Oliver, who organized North Corporation 15 years ago. The corporation made an S election last year after it accumulated $60,000 of earnings and profits as a C corporation. As of December 31st of the current year, the corporation has distributed none of its accumulated earnings and profits. In the current year, North reports the following results. The corporation has not provided significant services nor incurred substantial costs in connection with earning the rental income. The services income is derived from the active conduct of a trade or business. A, is North subject to the excess net passive income tax? If so, what's the liability? All right, so before we make that calculation, just looking through, we see we do have quite a large amount of passive income. We have dividends and we have rental income, and together that's $160,000. The only other income we have that isn't passive is services income, but that's only $50,000. So more than likely we are going to be subject to the excess net passive income tax. And at the very bottom of this slide, you can see I put the formula down there for you. So the answer is yes, but let's calculate it. So excess net passive income equals net passive income times passive investment income minus 25% of gross receipts divided by passive investment income. Okay, so net passive income, looking back over here, is going to be gross passive income minus any expenses attributable to the passive income. So we know we have dividends and rental income, and adding those up, it's $160,000. We also see we have expenses related to rental income. So net passive income is going to be the $160,000 minus any expenses attributable to that income. Here it's $30,000. So our net passive income is $130,000. We multiply that by, in the numerator, total passive investment income, that was $160, minus 25% of gross receipts. So back over here, we can add up the 60, the 100, and the 50. That's all of our gross receipts. That adds up to $210,000. So in the numerator, we have $160,000 minus 25% of $210,000, and we divide that by passive investment income, which we've already calculated to be $160,000. So my excess net passive income is $87,344. To determine the tax on that, I take the excess net passive income times the highest corporate tax rate. Remember now it's 21% across the board. So 87,344 times 21% is $18,342. The S Corp has to pay that tax in the form of estimated tax payments during the tax year. Part B, what's the effect of the excess net passive income tax liability on North's pass-throughs of ordinary income and separately stated items? So that excess net passive income tax reduces on a pro rata basis the amount of ordinary income and separately stated items that were subject to tax and passed through to the shareholders. We reduce it as follows on a pro rata basis. So they paid a total of $18,342, and of that, they paid that based on this net passive income, which was composed of dividends and rents. And you can see we are allocating it based on the relative value of those dividends and rents. So dividends composed 60 of $160,000 of that passive income, and rents composed 100 of the 160. So you can see the fractions in the table. We take the 18,342, multiply that by the fraction to get the amounts allocated to each item. And then we reduce the allocation of dividends by that 6,878. We reduce the allocation of rents by the 11,464. And then part C, what advice would you give North regarding its activities? How could North avoid this result? Well, they could earn more active income, right? Because this is for excess net passive income. If they had more active income, they wouldn't be subject to this. They could earn less passive income, or they could distribute the $60,000 of Subchapter C earnings and profits to its shareholders, or distribute the stocks and or rental property to the shareholders. And your last sentence, if the passive income situation persists for 3 years, the S election will terminate. Another special tax that may apply to an S Corp is the built-in gains tax. That's going to apply to any income or gain the corporation would have included in gross income while a C corporation had the corporation use the accrual method of accounting, and that the corporation reports during the 5-year period beginning on the date the S Corp election took effect. So there's a gain on the asset disposition in the 5-year period, and the disposition is going to include the sale or exchange, collection of accounts receivable by cash basis taxpayers, collection of installment sale obligations, completions of long-term contracts by the taxpayer using the completed contract method. As you can see, this is trying to prevent corporations from operating as a C Corp and then switching to an S Corp to avoid recognizing these built-in gains and income. Built-in losses are any deductions or losses the corporation would have deducted while a C Corp had the corporation use the accrual method of accounting, and that the corporation reports during the 5-year period beginning on the date the S election took effect. These can be from the disposition of property, and they're going to be deductions claimed during the 5-year period attributable to periods before the first S Corp tax year. These are the steps in computing this. So step 1, we want to determine the corporation's net recognized built-in gain for the year. Step 2, we're going to reduce the corporation's net recognized built-in gain by any net operating loss or capital loss carryovers from the prior C corporation tax years. Step 3, we compute a tentative tax by applying step 2 amount by the highest corporate tax rate. And in step 4, we're going to reduce the tax from step 3 by any general business credit and minimum tax credit carryovers from any prior C corporation tax year. So in step 1, we're determining the corporation's net recognized built-in gain for the year. And here's a little more about that. That net recognized built-in gain is going to have a limitation. It's going to be limited to the smaller of the excess of the net unrealized built-in gain over the total net recognized built-in gain for prior tax years beginning in the 5-year recognition period. So the smaller of that, or the S Corp's taxable income, as if it were a C Corp, but with no dividend received deduction or net operating loss deductions. When the net recognized built-in gains and losses exceed the corporation's taxable income, that excess is going to carry over to the next tax year, and the tax passes through to the shareholders like a loss allocated proportionally among net recognized built-in gains that resulted in the tax being imposed. In problem 35, we have Theta Corporation that was formed 15 years ago. In its first year, it elected to use the cash method of accounting and adopted a calendar year as its tax year. It made an S election on August 15th of last year, effective for Theta's current tax year. At the beginning of the current year, Theta had assets with a $600,000 fair market value and a $180,000 adjusted basis. During the current year, Theta reports taxable income of $400,000. In the current year, Theta collects all $200,000 of accounts receivables outstanding on January 1 of the current year. The receivables had a 0 adjusted basis. On February 1, Theta sells an automobile for $3,500. The automobile had a $2,000 adjusted basis and a $3,000 fair market value on January 1 of the current year. Theta claimed $800 of maker's depreciation on the automobile in the current year. On March 1, Theta sells land, a 1231 asset, that it held 3 years in anticipation of building its own office building for a $35,000 gain. The land had a $45,000 fair market value and a $25,000 adjusted basis on January 1 of the current year. In the current year, Theta paid $125,000 of accounts payable outstanding on January 1 of the current year. All the payables are deductible expenses. What's the amount of Theta's built-in gains tax liability? So we can see from this prompt that we do have some built-in gains. We have receivables. They have a 0 basis. They collected $200,000. We have an automobile that we sold and that had a lower basis, so we had a gain there. And we have land. We sold it. We had a lower basis. We had a gain there. So we want to calculate the built-in gains tax liability. And you might look back at your notes and go step by step with me through this problem. I think it'll make more sense. So remember, step 1 was to determine the corporation's net recognized built-in gains for the year. And that's what they're doing at the top. So we had receivables. We collected $200,000. They had a 0 adjusted basis. So that was a $200,000 gain. We had an automobile. And looking back at the automobile, I sold the automobile for $3,500 and it had a $2,000 adjusted basis, so there was a $1,500 gain. But you will notice on that next slide, if you notice that the built-in gain was only $1,000, and the reason for that is because the automobile had a $3,000 fair market value on January 1. And January 1 is when we made this S election. So the built-in gain for the automobile was $1,000. The same thing happened with the land. The land, they recognized a $35,000 gain, but the land had a $45,000 fair market value and a $25,000 adjusted basis on January 1. So the land had a $20,000 built-in gain. And then we had accounts payable, which we paid, which were deductible expenses. So that reduces my built-in gain. So my net built-in gain is $96,000. My net recognized built-in gains for the year, $96,000. That was step 1. Step 2 would be to reduce that by any net operating loss or capital loss carryover from the C Corp. And we don't have any of that. And then step 3 would be computing the tax, and step 4 would be reducing it by any carryover general business credit and minimum tax credit. Remember, step 1 also had those limits, right? So we're determining the corporation's net recognized built-in gains for the tax year. But those net recognized built-in gains were limited to the smaller of the S Corp's income for the year or the excess net unrealized built-in gains over the total net recognized built-in gains for the prior tax years. And you can see that's what they're doing under here, where it says current year taxable income was $400,000. The net unrecognized built-in gains were $295,000, and then the recognized built-in gains were $96,000. So the $96,000 is the smallest, so that's what we're going to go with. These limits don't apply. You can see the net unrealized built-in gains is calculated by taking the unrealized built-in gains, which is the $600,000 fair market value of assets, minus the $180,000 adjusted basis of those assets, and then subtracting the unrealized built-in losses, which was that accounts payable. And so when I do that subtraction, my $295,000 of net unrealized built-in gains is one of my limits. But again, our recognized built-in gains are lower than those limits. So in step 3, we take that recognized built-in gain and multiply it by the highest C Corp tax rate. Again, this year it's 21%. So my built-in gains tax liability is $20,160. And that built-in gains tax liability is going to reduce the income pass-through for the receivables, the automobile gain, and the land gain on a ratable basis, so on a proportional basis.